Welcome to the Gray Report. I'm your host, Spencer Gray, and if you are a multifamily investor, maybe you are interested in being a multifamily investor, well, you're in the right spot because every single week on the Gray Report, we're breaking down all the latest articles, research reports, any data that's coming out that involves the multifamily industry, real estate, and the macroeconomy in general. And we've got some really interesting reports today. We're going to break into an interesting article from Globe Street talking about is multifamily going to have a downturn, and is that imminent, and is it well overdue? I mean, we've had a great long run in the multifamily industry. Also, a report from RealPage, record apartment construction volume across the United States from Berkadia. We're looking at interest rates and multifamily performance from Apartment List. We're looking at the National Rent Report for October 2022. And then from the National Multifamily Housing Council, looking at their quarterly survey of market conditions. A lot to go over, a lot of important information. If you are looking at making an investment into multifamily, you're just thinking about it, you're trying to learn more, this is the stuff you need to know to help you make a really good decision. Joined by Matt Bosnagel, Director of Communications and Marketing here at Gray Capital. Let's get into it. Welcome back to the Gray Report. It's another fascinating week in the multifamily industry. Macroeconomy, we are just awaiting a press conference, Matt, from the Jerome Powell is going to get out here and most likely tell us we've got another 75 basis point increase to the Fed funds rate. The interest rate volatility has certainly kind of underscored in the moving markets and the challenges that we're facing. Again, all real estate, a lot of asset classes, but multifamily not removed from that challenge right now.
I was telling you last night, I felt like I was in the bowels of a ship looking over the maps and everything. I was looking over these trend lines for interest rates and 30-year mortgage rates and home sales and just trying to figure out, okay, what does this look like? And I was like, I almost have it. I got to write this number down, but it was all,
Yeah, I mean, at the end of the day, when things move around, interest rates, rents, whatever it is, marginally, that doesn't always move the needle on a macro level. But at the end of the day, when an investor is making an investment into any kind of real estate, but we're talking about apartments, they're looking at what their return projections are going to be. And when your cost of debt, which is basically your largest expense at a property, your one line item expense, and it is such a factor on your returns because it's a highly levered industry, highly levered investment class, it limits the price that one can pay. And that, if that doesn't affect pricing, I don't know what is. But the question is, who does it affect? Why does it matter? So if you're in the market of buying something, how do you do that? Yeah, almost impossible. Almost not impossible, but it's close. And then if you're looking to make some kind of decision on a capital event, sell or refinance in the near term, if you just bought something, if you bought something in 2020, 2021, you've got a good debt on it, fixed interest rate or floating with a cap. You're in a good spot. You're not going to want to sell right now, but you're cash flowing and you can ride out the storm. Yeah. But for everybody else trying to get into the space, maybe you're looking at doing your first deal. You just got started, you've done a deal, you want to do a couple more. It's challenging of how do you participate in this challenging environment where the numbers don't work and the price that is needed from a buyer's perspective, we're so far away from that price and what the seller wants. Yeah,
the market is not really relatively tight, and we'll go over the NMHC sentiment on market tightness, but it's definitely not commensurate with all the other indicators of where the market is. I still think that there are people that are holding on, and rightly so, because really you shouldn't have to sell unless you really need to sell. There's a lot of reasons not to, and I think that we're just at the beginning a little bit of this higher interest rate regime, if history is any indication. And what I was thinking of this week was how much these rising interest rates have this direct effect on the financing situation for apartment investors, but it's at a it's a whole economy thing.
Yeah.
And
housing's so important for the economy.
Yeah. And the way the interest rates affect not only single family homes, but like people's jobs and other businesses, and there are ancillary effects that all kind of snowball into is what a recession looks like maybe. But I think that I keep coming back to, you know, what else is it? What is it about the economy aside from Jerome Powell, you know, putting his finger
moving the dials?
Yeah.
So Matt, you just said something that's interesting that I think is worth talking about, and it's a little contrarian to the consensus. But nobody knows, and I think what you said is just as valid. But a lot of people are out there saying, okay, well, yeah, maybe rates are peaking. You know, maybe the bond market is bottoming out, and you just have to wait.
Yeah.
12 months or so, and rates are going to be lower. You know, on the single family residential side, you hear this, marry the house and date the rate.
Oh, okay.
Being like, just, focus on, you want the house, buy the house. Yeah. You're not going to like your mortgage payment, but you're going to be able to refinance in a year or two. And so just don't worry about it right now.
Good sales pitch.
Yeah. Like, okay, don't worry about it. And then, multifamily investing isn't as emotionally driven. We're looking at return, so it's not like, well, I just love it. I love the paint and the location. I'm going to buy it. But I think there is a little bit of that out there of like, well, okay, well, the leverage in the loan sucks right now, but next year or 2 years we'll refinance. Maybe let's look at a bridge loan, something short term, or maybe we'll put up with a floating rate loan because I'm going to look at the, and I don't think this is a bad idea. The logic makes sense, but let me think about the average, interest rate over a 10-year period.
Yeah.
It's going to be higher for the first 2 years. 2 years at 6.5 to 7, but then the remaining 8 years of my projected hold, it's going to be in the 4% range, and so like I can have an average much closer to 4 than 6.
That's a good point. Is the options for sellers?
But you're saying sorry, I was long.
No.
But you're saying, like, looking back at the history. When we get into this higher interest rate environment, it doesn't necessarily just go back down to lower interest rates right away. This could stick around for a while. That's your point, and I think that is a higher probability that some may want to think because they don't want to imagine that situation because they like the idea of cheap and easy money.
Yeah, I think so. And we'll go over the numbers. This is part of what made me like pouring over trend lines and drive myself crazy in the middle of the night last night. But it does seem like they plateau in some of these key situations that people are using to compare our current period with. The way the interest rates behaved it wasn't just like we raise it, people get the picture, and then we put it back down. So there's a lot that goes into, and the Federal Reserve's mandates, they talk a lot about housing, but it's really about inflation in general. And once that's in control, then you can see. But I don't, last month it didn't.
Well, and people are saying that, okay, well, there's going to be a recession. The 3-month and 10-year Treasury yields are inverted, and we're trying to create a recession to increase unemployment. But what if you get unemployment to tick up a little bit, but there's still inflation?
Yeah.
The Federal Reserve, typically when in a recession, they lower interest rates to stimulate the economy, but will they make the conclusion that maybe we have to at least keep rates higher? Maybe they won't continue to raise rates. That would make sense. But they're going to keep them elevated because they see inflation being at a much higher risk than unemployment ticking up quite a bit. They want to get the wage growth down so we aren't in this wage and price spiral. And so they may not be able to lower rates as much as some people are hoping for. Yeah,
it will be really interesting because I still think that there are some things in the CPI, especially rents, that are a lagging indicator. But I think in general, it takes a little bit of time for the interest rates to kind of bake into the inflation equation.
Yeah.
And so we'll have to see, whether Jerome Powell's thinking that or not.
Yeah, real estate's slow. It has to trickle all through the economy, and it has to affect the bottom line, has to affect future projections, and decisions have to be made to, okay, we need to cut costs, we need to reduce our workforce. that all takes time, and then the workforce is affected, wages are affected, and then maybe it hits real estate.
And another thing I was learning last night, didn't take the markets long to react to the 2018 taper tantrum.
Yeah.
So like there is a possibility that people still have like not a knee jerk, but at least a reaction.
Well, yeah, the market. And so that's the thing. Markets are 6 to 12 months, into the future. They're trying to price, all right, what's going to happen in half a year to a year down the road. But then real estate is what happened 6 months ago or so. It's so delayed, which you can use the variance in your timelines, see through space and time to maybe make some decisions about the future.
That's what I was trying to do last
night. All right, so let's get into this first piece. It's the only really opinion piece that we're going to be looking at. Then we just got all kinds of just deep, heady reports that we're going to get into. From Globe Street, multifamily's imminent down cycle it's overdue, Matt. That's at least the opinion of this industry-leading experts. They are agreeing, at least according to Phyllis Klein, Senior Vice President, Head of Agency Production at Capital One.
Yeah. So interest rates got higher. Yes, I understand. But I keep asking, and I asked last week, what is it within the apartment market that has led to this potential down cycle? And I don't think it's really much at all like inherent in the apartment market, especially after reading this article. Like I don't think they put the blame on the fundamentals of the apartment market. It's really about interest rates.
Yeah.
And why am I including it? Because we've got other stuff about interest rates we're talking about, but it is a headline that it was the most clicked on headline. I clicked on it, and I think it's almost a warning. I'm guilty a lot of times of reading the headline and thinking like, oh, that's the point of the article.
Oh, they got you.
Yeah, and but I think that in this case, maybe there are some people like me that will read this article and like, oh yeah, well, we're long overdue. I think the word overdue and the way that I read it, it's like, oh, we did something wrong, like an overdue library book. But I don't think apartment investors did anything wrong as much as maybe the ones that assumed that low interest rates would go on forever. But that's the overdue. We're not necessarily the multifamily is not overdue, but maybe like we're overdue for higher interest rates. I don't know. It doesn't make for.
I can see. I mean, the markets there are cycles. I understand the argument. Like, okay, there's a cycle here. There needs to be a cycle. We can't just keep going up and up and up and up. And to your point, maybe it's not the fundamentals of supply and demand. Although we're going to be getting into supply here in a second of how that could be potential headwind. But it's more of there cycles and things that happen in the economy, and maybe it's macro and it's interest rate related, which right now it is. It causes certain cycles, and typically, cap rates, they rise and they fall, and they rise and they fall, and prices, they rise and they fall. The cycles, they're not perfect sine waves. There's not a 5-year, 10-year period of upside and then 10 years of downside. It's typically a long, ramp up, met with some exuberance at the end, and then some sort of correction. Not necessarily completely repricing going back to zero, but there's some reshuffling, and conditions are different, and it has to, come down before it can come back up. And looking that we were just in an incredibly long cycle across asset classes since the last great financial crisis. Housing cycles often can last longer than a stock market cycle, and they can sometimes weather through a recession. But I think this is just showing we've hit the thresholds of where asset classes are somewhat correlated. The stock market can crash, and multifamily doesn't move. We saw that during the pandemic. But then there are other macro events where real estate is correlated still to the economy. You can't have all assets, for the most part in the world, depreciating because of the cost of capital, and to have real estate be completely shielded.
Yeah, that's a really good point.
So it's like, but what's going to fall the least, and then what makes sense fundamentally over the long term? And if you're trying to time it real quick, your risk goes up substantially. If you have duration, you can make a pretty well-educated decision to move forward on something you can have a high degree of confidence in.
Yeah. Yeah,
so
that's a really good point. And it's not necessarily one that was nuanced in the article itself, but I think that's why I wanted to include it too, is because I knew you'd have a good take on it. But also, I did appreciate their discussion of the importance of looking at local markets. Something I said, something we've said before, really. And real estate's always hyper local, so that should be kind of an assumption. But the huge national rent increases that were shared so widely across the nation in 2021 made studying local a little less important. Like, you could pick anywhere on the map, you're probably going to see some rent growth there. But now that and increasingly,
and cap rate compression is just like everything's trading for a 4 cap.
Yeah. But I think this slow return to the relevance of local variation in the apartment market, some markets are doing better than others, is kind of a reminder that, like, when you're entering a little bit more of a volatile economy in general, you're going to want to make a better pick. You're going to want to pick places that and that's where, especially when it comes to supply, that's where you can kind of find a better.
Well, yeah, and exactly. And we're going to talk about that in just a second, Matt. But yeah, I mean, some markets are, similar size, are delivering 10,000 units. Some are delivering 4,000 units or 6,000 units. And because there is a little bit of slowdown for demand right now, I think you need to be more granular, more market driven, more business plan focused, and then also you can't just count on just growth. You have to really count on managing more efficiently and keeping expenses in line.
Yeah,
because utilities are going up, property taxes are going up, payroll's going up. There's certain expenses that you're not going to be able to get around, and so how are you going to manage these assets more efficiently than you have in the past? Whether that's being more efficient on payroll, on your capex, where your dollars are going towards. How are you going to be utilizing technology? So you can grow your rents, your revenue by 10%, but if your expenses also grow by 10% or 11%, you got a great top line number, and you can tell your investors, we grew rents by 10%, but we missed on net operating income.
Yeah.
So that's what matters at the end of the day. It does a dollar gained from your more rent is the same as a dollar saved on your expenses. Yeah. So it at the end of the day, it's all going to be about getting into the details and who's got the the experience to know what to do.
Yeah.
Let's talk about NMHC, man. Okay, so this is related to kind of sentiment, and again, it's a feeling, because I don't disagree with the Globe Street article. It's like, all right, cycles. We're in this period of resetting prices. Makes sense, but we're in a completely different situation in terms of sentiment of what buyers and owners were thinking compared to a couple months ago. Certainly, a year ago. It is all sentiment. So NMHC does a quarterly survey for this. It came out in October. This is just, they're interviewing a bunch of apartment owners, managers, asking first, how tight is the market? A 100 is going to be incredibly tight, which means that it is a seller's market. There's a bunch of buyers. 1 is like there are no buyers. It's a total buyer's market. So let's look at that first. So going back, first let's go back a year ago to October 2021. The market tightness index was at 82, which is pretty high. I mean, it was higher back in July of 2021, but in October it was 82. So it cooled a little bit, but pretty tight. I mean, we can go back all the way to 2018, which is as far back as at least this goes.
Yeah, there's some historical that go back to 2009, but
well, yeah, we'll look at that here in a little bit. But so, I mean, typically the market's been kind of in, call it a 30 to 50 point range, maybe 60. So it's like, moderately tight, kind of right there in the middle from 2008. But then you can see, obviously COVID happened back in April 2020. It dropped all the way down to 12. There were just no one was buying anything.
That was market tightness.
No one was doing anything. Yeah. So it was very, very loose, very, very loose market. And then you can see it gradually increasing until July 21, and it was as tight as it has most likely ever been. And then it has been on a decline since then. We're all the way down to 20 now in October of 2022. This is it is not as loose as it was back during the heart of the pandemic, but it is as loose as it was any point since then, since 2018. So sales volume, how much is trading? Again, going back to October of 21, we're at 79. A lot was trading. 79. July 2021, same thing, 79. That was a lot of transactions. We're down to 6, Matt. We're down to 6. Same spot we were back in the beginning of the pandemic in April. And then, we've never been anywhere close to that. So not a lot can trade because of what we just talked about. Interest rates are high. Cap rates are still relatively low. The debt market does not make sense for the majority of acquisitions. Equity financing. How easy is it to raise the equity to buy these deals? What's the interest level that's out there? Again, this is just an opinion. And so it's definitely an anecdote, but a pretty well educated one. We're at a 12 on the index. Again, 0 would be like there is no one investing in apartments. We can't raise the money. 100 being like the helicopters are flying over with the money to put into apartments. So we're at 12. That only compares. The closest is, again, April of 2020 was at 13. Harder to raise capital now than it was back in the beginning of the pandemic. And that is in contrast from back into July 2021. That's obviously the peak. It was coming out at a 69 on the index. That meant it was relatively easy to raise equity. In October 21, so exactly a year ago, it had gone down to 65. But let's just see. I don't think there wasn't a point that was easier to raise equity according to this survey, other than spring and summer of 2021. Now, this isn't going to be a surprise for most, but on the debt financing. How easy is it to get debt? Isn't it accretive to the deal? Good time to borrow money. Right now, October 22, it's at a 5, pretty low. Surprisingly, back in July of 2022, it was a 3, even lower. I think that's relative to cap rates were even lower at that point. And I don't know, maybe we're kind of getting numb to the fact that interest rates are rising. Back in July, it was a relatively novel concept.
That's what I think, that so much of this sentiment is the sense of difference between conditions that we used to have and conditions that we have right now. I don't know, I think that I've said this about this exact chart. Look, I don't know how the human heart works or how sentiment works exactly. It's not a science, but the feeling is there, and that's going to drive the market. If you don't feel like selling it, then you're not going to sell something.
Exactly.
And another thing too about the debt financing, and maybe we're going to get to this, is that seems to be guiding the other elements of this chart too.
Yeah. Absolutely. I think equity and debt financing definitely lead the way. Again, comparing, so we're at a 5 right now. That means like the debt is no good compared to last year. We're at a 48, and then again back in July of 21, we were at a 71. Which the only time people said that it was better was back October 2019, and I guess the reason for that is that we had gone through the taper tantrum in 2018, and maybe things were kind of just normalizing a little bit. Rates had come off a little bit. That's just my hypothesis.
So I did mention that I looked at they have like a historical the historical data, and I went back as far as I could, which was January 2009. Potentially not the lowest exactly point of the housing crisis, but really close enough for comparison. And today the market is slightly tighter. Sales volume is worse. Equity financing is the same, and debt financing is worse. So that's
going back
where
into the great
is.
GFC, Great Financial Crisis.
Yeah. And you can definitely see that in the chart there. But,
so I mean, this volatility, I mean, that makes sense, because that's like the emotional swings that everyone's going through.
Yeah. It's really interesting. Wow. To look at the market tightness seems to be the strongest change. There's a lot less people think that the market is tighter today than it was last quarter. But I
believe. I mean,
just one of many.
I believe. I mean, we've seen the terms change on deals quite a bit, and just sellers. If you've got to sell, it's not a great position to be in. So. Let's do a little bit of a turn, Matt. Our friends over at Berkadia, they've got a new piece out, multifamily and interest rates. We're talking a lot about interest rates. The whole world's talking about interest rates today. I feel like we've been talking about interest rates now for I don't know. It seems like we'll always be talking about rates.
Yeah.
Usually they're a little bit more steady Eddie. It's not a huge story. And then it was inflation. Well, really, we were talking inflation. Material cost was rising. Single family homes. Now it's all about interest rates.
Yeah. Well, I think that, and like I said before, it's interest rates as an equation for the larger economy and as a factor into the housing market. And then there's also I think we also have been talking a lot about the kind of specific application of interest rates in the apartment market, which is the direct, what is it? How is it going to affect the math that you do, and about and how you structure a deal? But this made me think and really got me down several rabbit holes about what does the interest rates of today and the economy of today look like, specifically housing sales, but how does that compare with the early 80s? And the Great Financial Crisis. We covered this in an article from InvestTech last week, but this one has some additional relevance for multifamily investors specifically. So I appreciate this and the subject matter for sure.
So what were some of the conclusions, Matt? I guess that Berkadia made, and then let's go to the other source. We're looking at some more historical data. I mean, just to read the headline, today's soaring mortgage rates and declining home sales trends mirror periods before a crash. I don't like the sound of that.
Yeah. So it's basically positing and pretty compellingly that this is certainly rhyming with these two moments. We saw it before, but it's interest rates go high, home sales go low. And my question is then, is how similar is this to the points in the past, and where might we be compared to the past? Are we on the way up? Are we on the way down? How the strength of previous crashes? Are we in for that? Something that's that strong, or are we in for interest rates that are that high? I'll tell you one thing that I learned is that the interest rates did not behave. The interest rates were crazy in the 80s, not so crazy in when it comes to the Great Financial Crisis. So
they increased, but wasn't. Yeah, but we didn't have. It wasn't not for necessarily the same issues. They're trying to cool the economy down a little bit, but not. Yeah, it wasn't the crazy inflation.
The inflation environment was different, and the kind of underlying fundamentals, especially financing of housing in general, was different. So
that's what I was going to say. As much as you never want to say, well, this is just different. We have to ignore the past. There are some fundamental differences. The way the foundation, the bedrock of the economy, the changes in banking laws and the risk that banks can take, as well as the way housing has been financed over the last cycle of, very few floating rate or adjustable mortgages. People are actually having their credit checked. People are creditworthy to buy them. And then we have all these people, home buyers, who've either bought a home or refinance at incredibly low interest rates. So they're not going to have necessarily the pressure to sell that was caused back in 2006, 2007, leading to the Great Financial Crisis as interest rates rose. The teaser rates and the rates on their adjustable mortgages, went from, you were paying a 3%, now all of a sudden you're paying a 6.5%, and people couldn't afford double the mortgage payment. Then they would default, and then they lost their job at the same time as unemployment was high. So there's a lot of differences between now and then, but we can't ignore that. Is there some rhyming? And maybe the downturn isn't going to be as painful, but the market's still going to be affected. There's still going to be some pain and some losses, whether they're realized or not. I think that's the big question. Yeah.
So this does have some charts that compare, and I was looking for the chart of our current situation, but they only have the charts for the previous situations. Fortunately, there was this link from...
That's only so helpful.
Yeah. There was a link from Mortgage News Daily that has everything really neat and clean when it comes to comparing 30-year mortgage rates, and I'll put that in the YouTube notes for sure. But it has mortgage rates, 30-year fixed-rate mortgage compared with existing home sales. And you can see, depending on where you're kind of limiting the period of the graph, you can really see where the drama happened in the early 80s, where the drama happened in the mid to late 2000s, and then where we are now. So I think our current in both the 80s and 2000s, when interest rates fell, they fell quickly, but the run-up in interest rates was much, much steeper in the 80s than it was in the mid to late 2000s. I said that. And I think our current situation, both in terms of mortgage rate trends and general economic trends, is much closer to the 1980s than the late 2000s. So first the trends, and then I can kind of get to the conditions. Mortgage rates are increasing at close to the same speed now as they were in the 1980s, in the early 80s. In December 2008, the federal funds rate was near zero, but the 30-year fixed rate mortgage was 5.29. That 5% spread between mortgages and the Fed's funds rate, I'm sure, that's the great financial crisis. That's because there was something, weird about the housing market. And then in May 1983, the Fed funds rate was at 8.63 and mortgages were at 12. So it was at 12.63, which is like a 4% spread. So there's already a little bit of a difference, at least a 1% difference. But again, I think that there was significant lag between the Fed rates and the mortgage rates after the great financial crisis. In the early 80s, mortgage rates actually did seem fairly closely aligned with what the Fed funds rate was at the time. For our current situation now, the mortgage rates started their steep increases in January of this year, and the Fed started their interest rate increases in March. If we were to follow the same path as the early 80s, we're about halfway there. The relevant stretch of mortgage rate hikes in the early 80s was about a 6% increase. Currently, mortgage rates have gone up about 3% between December 2021 and now, between March and now. That was the mortgage rates have gone up 3%. The federal funds rate didn't get started till March, so it was almost like an anticipatory effect.
Well, it is because most mortgage rates today, are not based on the Fed funds rate, but more on closer to the 10-year Treasury, plus a spread. But so the question that I would be curious in going back on learning is the makeup of mortgages back in the 80s, were those mostly fixed or floating? Because we know back in 2006 to the great financial crisis, a lot of those were variable. Now we see more fixed rate, 30-year fixed, 30-year, 15-year fixed versus variable ARM. But so what was the makeup back then? But then it's true because the 10-year Treasury is a much more market-driven rate rather than the Fed funds rate. The Fed just pegs whatever they say it's going to be.
Okay.
And then SOFR and the Fed funds rate are much more in line because it's just shorter term. It's more of like a money market of what's available right now for short term lending. And if it's a variable rate, it's adjusting. So it's on a monthly basis. So it tracks much closer. But the 10-year is a market that's being driven certainly by central banks and governments, international investors, and it is a little bit more, can be a little bit more of a predictor of the future, and it will anticipate some of those Fed increases, and that's why the 10-year Treasury rose pretty substantially, and then even the 2-year Treasury has been much higher than the 10-year Treasury for quite some time. Because it's just outpaced, and the market is moving it forward because people are selling 2-year. People were just dumping the 2-year Treasury. They were selling the 2-year Treasury, and then people are selling the 10-year Treasury. So I think your analysis is definitely on the right track. But I just had those are the questions I have of what's the breakdown of the mortgages, and to see, is this time different? That's what we're trying to figure out. Is are we going to have an analog, or is just the differences in the economy and the housing market going to allow for some kind of easy, soft landing?
So it definitely feels like similar issues, but I think it's half strength. I don't think we're really in the 1980s. Inflation is about half as strong as it was then. Interest rates have increased about half as much as they did in the early 1980s. Employment is around 3.5% and nowhere near the 8 to 10% that it was in the early 1980s.
And that's one of I think the biggest differences right there is the unemployment. That's what just kind of throws the whole equation out of all right, we're just in a different time. Everyone's got a job and there's good wage growth going on right now.
And that was the key. It was really gut-wrenching to look at the unemployment rate post Great Financial Crisis. It took so long. It took so long for it to normalize. After the 1980s one, it it was a much faster reaction. The ultimate rate may have been a little bit higher than it was, but again, the reaction was relatively quickly. So I think that having covered all of this economic context in comparison, I am interested in how the multifamily market fits into this, but I think that before then, two of the key year-long periods that I wanted to highlight, and this is what I was getting at when I said it seemed like about a year where we had high rates, was between May 1982 and May 1983. Is this year-long so it was when the rates were high, and then they started their decline, and that took a year for things to kind of get back to normal from the peak of from a peak of this early 1980s interest rate regime, and then to the really a determined decrease. That took 2 years, and that's when it comes to mortgage rates. Now, when it comes to the federal funds rate, it's roughly similar. It maybe lags, or it's maybe a little bit forward, but whatever. We got it. Potentially, it takes a year, and that's looking at this, it's a steep decline to get that 6%, or however much it was off the interest rates for mortgages.
Yeah, they went from an 18.45% 30-year fixed mortgage rate all the way down to a 12.63. So all compared to. People who lived through this will often remind us, like, I remember getting a 12% or 10% rate and being happy about it because they remember, this period. Although it's amazing, this period always gets mentioned of like, the rates can easily go back, but it's not even like that we had this crazy peak right here. It's not like that went on for that long. I mean, it was definitely high, but between 1978 to 1986. So good 8 years of kind of plus 10% mortgage rates.
And then another the key analog then in the late 2000s was, I think it was between October 2008 to October 2009 is where, from kind of peak to trough, you see it takes about a year for these mortgage rates to come from really high to really low.
Yep.
So that is my back of the hand, back of the napkin, whatever kind of conjecture is. Even in a steep decline, it takes some time. Well,
and because what this is looking at is the 30-year fixed mortgage rate. What I would like to see is the rates on the variable, because the 30-year fixed didn't move as much, but it was the movement of those variable rate loans, which I don't know if there's an option here on this, but anyway, we'll look at it later. But because that's what really tipped the economy, the housing market and the economy over back in 2006.
So, but just like a couple notes to kind of connect it back to multifamily.
Yeah.
Berkadia does say that the fundamentals for multifamily are strong, and that ultimately investment activity in these segments and other strong performers should foster an environment that would promote significant growth throughout the remainder of the year. I want to pair this take with a quote from a recent Marcus and Millichap research brief that we don't have in here, but we'll have it in the newsletter. It says, in alignment with single family, apartment demand recedes. Higher debt service costs are not the only force behind slower housing demand. The multifamily sector is also undergoing a decline in leasing activity as the economy wanes, household formation contracts, and young adults face hurdles starting their careers and moving out on their own. There are two perspectives, I think, currently in tension with one another, and it's going to be clear very soon which one will win out. At the same time, it's possible both can be true, and apartment demand will meet in the middle, somewhere between fully insulated from the market and fully subject to the broader trends in the housing market as a whole. There's this idea like, renters don't pay loans, so that renters don't pay home loans, so they're going to keep renting, and rent growth will continue. And then there's another perspective, I think, that's like, well, yeah, but the whole economy is going to go down because other businesses use these loans too, such as houses.
Exactly. Just a slowdown in general, less wage growth, less people getting jobs, not moving around as much, might move in with a roommate.
Yeah. But even if we meet in the middle between these two, I do think that the historical trends and current conditions suggest far more stability for apartment rents than home prices, and that's something we've seen all year.
Yeah, no, absolutely. Well, let's talk about outside of just the super macro. This is still macro, but it gets into the more local level and something that's more multifamily specific, and that is the supply story. Record apartment construction across the United States. According to RealPage Analytics. We've been talking about this a lot, but this is another highlight. Now, it's a double-edged sword, Matt, because on one hand, we've got a housing crisis, and the only solution is more supply and more units. We're good, 4 million plus or minus short that we need over the next, a little less than a decade. Looks like we may be making a little bit of a dent in it, but again, these national numbers, they can be a little bit deceiving because there's a huge concentration in a handful of markets. But as a general rule, there is a lot of apartments being built across the United States right now. 924,000 are underway. That's incredible. I'm sorry, 917 units are currently under construction across the U.S., which represents 4.9% of the nation's housing supply in terms of multifamily. That's a lot. That's a lot, Matt. But we keep hearing that all these apartments are being built, but they're not actually being delivered. They're not actually finishing building them. Are they speeding up?
Well, then that was one of the points that I made a little bit when I was taking notes about this. Is this huge number is it kind of like a backlog that's just like piling up?
That's kind of what it seems like.
And with that in mind too. We're going to have to probably wait a while for some of these projects to be finished anyways. And it may just end up that we'll see completions at a, steadier rate than this huge wave of under construction would imply. I do think, one thing that makes me, and they do jump into the nationwide numbers. They have that 4.9%, and they have that huge, almost million units in construction. But they quickly shift to a local focus. And that map that you have up right now is the 16 markets with record units under construction. And just at a glance, looking at the numbers themselves, it's easy to see that not all of these markets are the same, both in terms of the share of the percentage of units that are under construction and the number of units, just the raw number of units. For instance, Dallas leads the pack with 49,185 units that make up 7.4% of supply, but a close second is New York City, which has 44,900 units under construction, making up only 2.3% of supply. And at the other end of this list, when it comes to numbers of units, they have a bunch of Midwestern markets highlighted here. Columbus has 8,768 units and 4.5% of supply, and Milwaukee has 5,755 and 3.6% of supply. They don't mention the percentage of supply for the other two markets on this list, but Kansas City's a little over half the size of Columbus and getting just as many units, so that might mean stronger than Columbus, maybe more than 3.6, maybe 4 or something, or 4 or 5%. And then there is Indianapolis, which is the percentage of supply isn't shown here, but Indianapolis is a little smaller than Columbus and has just under 3/4 of the units under construction comparatively. I don't know the exact numbers, but for Indy it could be about 3.3% of current supply, and then that is below the national average of 4.9%. But again, these are under construction; these are not completions. Now, last week or the week before, we looked at Yardi Matrix, and I know the numbers for Indianapolis completion. I don't have the other ones on the top of my head, but the completions, recent ones, were 1.3% for Indianapolis.
Yeah. There's been a big lag between actually announcing a project, and it's in the pipeline, and then actually getting the project done, leased up, delivered. That's taking a lot longer, but these will deliver at some point. So there is a lot of supply on the way, in that, depending on at the rate that they are delivered and relative to the already current supply and demand in the market, it's worth tracking because it could provide a headwind in some markets in terms of occupancy and rent growth. And this would most likely show up in the kind of the ultra luxury A plus class, because all of a sudden, you've got a ton of new apartments that are available in the market. Oftentimes a new delivery, they're making rent concessions and specials to get them leased up. And if you have a deal that was delivered in 21 and you had you raised rents already, then someone else gets delivered and they're $1,000 off and nicer, newer. It's got whatever the difference is between a 1 year of design, but it's just the freshest, best thing, better, good location. You're probably not gonna be able to raise your rents.
Yeah.
Now the big question is though, that might have some of those A-class, slightly older, a couple of years older A-class properties, is that they may have been delivered under a different cost basis. So maybe they're maybe they're 2 beds or they're leasing for $1,500. Because the cost of construction was, I'm just picking a round number, called $180,000 per unit.
Yeah.
But now the new apartment down the street that's just being delivered, construction costs went up, labor went up, it took longer to build, so the construction is like $220 per door or something like. It was really expensive. Maybe even more. They're going to have to get higher rents, and so maybe there's enough of a difference that even with that concession, that slightly older A-class property can still be competitive, but the newer ones still going to be the brand new thing.
Yeah.
But it'll be interesting to watch this at the pace of how these new units are delivered over the next couple of years.
Yeah, and I keep coming back to locality and kind of focusing on the local, like that Globe Street article said. I think that in some places maybe a newly built complex could draw apartment demand from maybe miles away. Some places from a half mile away. I don't know what the yardstick is, and I think
it all depends on the location and the jobs,
and maybe it's like the transportation and everything. But it's true. I think that it's not just a market issue. It's look at your submarket, maybe even look at the neighborhood or like a half mile area around, because that could affect everything. Especially when it comes to new apartment supply coming online. So
absolutely. Well, so that's talking about the future. Good to keep in mind. Let's talk about this last month. Let's talk about rent growth, national rent growth from Apartment List. Their national rent report this came out October 30th, 2022, and big headline: rents nationally fall by 0.7% month over month, but rents are still up 5.7%. year over year.
Yeah. This was of the rent growth numbers that we're following. Apartment List is actually the lowest, and we'll see what the other October numbers shake out to be. But it's definitely it's like about 2.5% away from the average when it comes to year over year rents. Month over month negative 0.7. They're really hanging this on seasonality. I think this is definitely, even at a glance, stronger than seasonality.
Yeah, that's exactly what I was gonna say.
Yeah. So I wonder if, and again, if we're also going with seasonal trends, November is about the same as October, and that's like the lowest, and then the rent decrease weakens in December, maybe is about at 0 or maybe a little bit positive in January, and then it continues to grow through the renting season.
It's just the waves are larger. Just the standard deviation is greater than it was in the past, and so we saw huge gains, and so it makes sense that those waves move in the opposite direction, and we'll see larger than our normal seasonal declines. Again, I don't think we're not going to have a reset and a correction back to a year rents a year and a half ago, just because wages have moved so much, and we are unemployment is doing so well. But I think we are seeing more than a little bit of just seasonal adjustment, and I think again this goes back to prices of everything around the world are kind of reshuffling, resetting, and the alternative would be the alternative of the entire global economy went through this massive disruption that was COVID-19 and government stimulus and war, all of this stuff. To think that the market priced it perfectly back in July of 21, like that was the perfect pricing. Everyone knew back in July of last year that things were nuts, like absolutely insane.
It was uncomfortable.
It was uncomfortably nuts.
Yeah.
And so this this makes sense, and you would think that there would be some reversion and correction, not a full reset, but at least some sort of reset to we're we're in a period of price discovery. Same thing with buying a multifamily apartment, buying any type of commercial real estate. You're buying stock, whatever it is. What is the price of certain things? It was way up here. It was down here. Maybe we're not going all the way back down, but where? So, okay, we're going to go to the middle. Where in the middle? And that's what we're all trying to figure out right now. And no one wants to really make a bunch of decisions because they don't have that information. The market's not being given steady pricing information. And again, coming back to interest rates, how do I know what to pay on something if my biggest cost, the debt, my interest rate, I don't know what that's going to look like until I am down the road of buying something, but I don't know what my cost of capital is going to be. How do I make a decision on that? In previous years, we had a pretty good idea of, okay, interest rates are right here. They haven't moved much. This is kind of where we know in general terms of where the interest rate is going to be. You add a little bit extra on to be conservative in case you don't get that. I mean, even back in the pandemic, again, going back to 21, if you're doing a floating rate loan, it's like, well, SOFR's at zero. It's just stuck at zero. It was stuck at zero for over a year. So like you knew it would just whatever your lender was going to, the spread your lender was going to charge or whatever the floor on that interest rate is. It's like, all right, we're paying 2.5% until SOFR moves. Like I know that. But now, I mean, the 10-year was 4.3. A week and a half ago, the 10-year was 4.3%, and then it was 3.95% a couple of days later. Then it was 4.1% the next day. That's hundreds of thousands of dollars in loan proceeds. It's major changes to cash flow. Yeah, and now that's just within like a week. If you're looking at 90 days ahead of time making the decision to plan out, and then you're supposed to go to equity partners, capital partners, and here's our business plan, but our biggest expense, we really don't know what it's going to be, and that's going to be the difference between which will affect how much equity that we actually need, and it could affect it in the millions of dollars. It's like on one day, again, 10 years at 4.3, okay, well, we're going to get $2 or $3 million less in loan proceeds, which means that we have to go out and raise an extra $2 to $3 million. Can that be done? Absolutely. But like, it's not like a.
Well, that's the fear, I think, of the stagflation environment. It's not necessarily the stagflation itself. It is what's done to react to it, to correct it. I do think, if we're judging by timing, the run up is. I'm hoping it's done.
I mean, we'll know soon. 75 basis points here in November, and then 20. People are saying 25, 50 in December.
In all of the reporting, no matter whether it's the doom and gloomiest of all, no one has really said like, well, buckle in because renters are going to stop renting. Renters are going to stop paying rent. There's nothing in the apartment market that suggests that. And I think that a lot of this is going to be a factor of the general economy itself. And in those cases, you're going to have to look for maybe stable assets that will last beyond it.
That's the thing. I mean, some things are going to be moving all the way up and down and crashing, where multifamily and apartments they're going to be moving, but it's going to be much steadier than most other asset classes. I don't think we're going to see nearly the declines that other asset class investments are going to see. And then pose for a lot of growth as soon as we get out on the other side of wherever that's going to be, and who knows what that's going to look like.
I'm excited about 2023.
I'm excited about right now. I mean, this is like, these are the times. These are the times you go back and we talk about, or you talk to colleagues, or you tell your kids about, in the trenches, in COVID, and digging in the foxhole, as J-PAL is getting ready to unleash weapons of mass destruction. We've got a ground war going on in Europe, and we've got to make some decisions, and millions of dollars are on the line, every single day, and so it is fascinating from an observer of the economy and the investment space. It can be very humbling as an investment manager and putting projects together. It makes you have to stay true to your convictions and understanding, okay, what's thinking about risk management, not just as saying that we're thinking about it, but truly having to implement risk management practices and procedures. for a variety of different reasons. I think this is where folks are going to, earn their stripes, and people are going to do incredibly well, or people aren't going to do anything. People are going to crash and burn. And it's, but again, I think we do need to buckle up, but I think I'm very optimistic for the next couple of years. Because I'm confident that we can navigate it, but it's going to be it's going to be it's going to be a wild ride.
Yeah, I'm excited.
Strap in. All right. I hope you enjoyed this episode of The Gray Report. Make sure you subscribe to us on YouTube. If that's not where you're watching, you listen to podcasts. Appreciate that. If you are on YouTube, subscriber, you can hop us over and check us out on the podcast. That's you're working out, you're driving, you're blowing snow, I guess, here in the future. Like, I want to listen to The Gray Report, get updated. We've got that as an option. Check out grayreport.com also if you're like, I want to stay up to date all the time. We got all kinds of great links and clicks on grayreport.com. And then if you liked what you heard in terms of like, hey, I'm an accredited investor and I do want to get on multifamily. I've heard these guys, they've got some really interesting deals. They're assuming some debts, getting some really low interest rate, buying deals at high cap rates that are still cash flowing, things that make sense. They're, looking at risk from a management perspective. I want to learn more. GrayCapitalLLC.com. Learn all about us, or go straight to Gray.fund. You get the full information on what we do at the Gray Fund. Love to have a conversation with you and see if it's a good fit. Obviously, only open to accredited investors. I couldn't even tell you about it. Matt, any closing thoughts, comments?
No, I'm ready. I think good things are still going to happen.
Good things are still going to happen. They can. Good things can and will happen.
That's right. That's good.
Yeah, that is good. I like that. Good things can still happen. It's possible. All right. Well, let's keep on keeping on. Have a good rest of your week, and we'll see you on the next episode of The Gray Report.